What is up, everybody? Welcome back to our stream. I missed you guys since pre-market prep. It's been a long hour without you. Welcome to a brand new show that we are starting right now. This is called our Listmaker Series, and let me first talk about the reason behind this show and what the point is. We spend all day talking about the stock market. We talk about stocks. We talk about crypto. We talk about the daily movement up and down. There is so much more. We've asked for feedback. We've gotten this feedback. There is so much more to the world of investing than just stocks. There's real estate, okay? There's startups. There's collectibles. There are other platforms. There are other assets out there that demand your attention, frankly. We're in an inflationary environment. The Fed's raising rates. Who knows what that means going forward for the future of the stock market? But there are other asset classes out there that are important and are worth talking about. Now, historically, these asset classes were limited to high net worth investors, the rich people, but not anymore, because there are dozens of companies out there that are actually providing real everyday people access to these alternative asset classes. That is the point of this show. We are going to highlight the companies that are providing access to asset classes that were traditionally off limits to everyday investors. So we're going to be doing this show once a month, and they're going to have a theme. This month's show, today's show, is alternative investments. We're talking real estate. We're talking startups. We're talking collectibles. That's the theme of this show. So we've got about 18 or so companies we're going to highlight throughout the next hour and a half, and we're going to tell you a little bit about them, how you can learn more about them, and we'll have some conversations. We're going to talk about real estate. We're going to talk about what makes a good startup deal. And as always, if you have any questions, drop them into the chat. But we've got a great group of companies today to talk about. Before we go any further, first let's thank the sponsors of today's show: Red Swan, WeFunder, Cadre, CrowdStreet, and Dealmaker, without whom this show would not happen. So, without further ado, I'm going to formally start this show. All right, so let's do this. Let me throw it now to our first segment here. I'm going to bring on Luke Jacoby, aka Hot Stocks Luke, and Benzinga's alt investment guru Kevin Vanderboss. They're going to run through the list, all the companies that are on our alternative investment list today, and Kevin's going to tell you a little bit about what they all do. So, guys, Kevin, Luke, good morning. What's going on?
Good morning, Spencer.
Good morning.
How
are you doing today, sir?
Doing fantastic. It's good to see you up there, both of you. You don't usually sit up there, so it's great. It's great to see you both. And yeah, awesome. So, yeah, I'm sorry.
I was going to say, as Spencer mentioned, I'm Luke over here on the Benzinga team, joined by Kevin Vandenboss, managing editor of our alternative investment content. And before we dive into it today, I just want to give a little bit of more preview as to this Listmaker series. What we're kicking off for 2022 is we want to recognize the companies that are really moving the needle in investing. How are we getting to that next frontier? As Spencer talked about, we're going to focus on alternative investments today. That's where we're starting off. But these companies that we're going to recognize today and in coming months we should truly be proud of, right? They, of course, should be proud of the work that they've done and the contributions that they've made. But we, as consumers, as individual investors, I'm an individual investor just like everyone else out there, should be proud of the work that these companies are putting in. It's really, really a badge of honor to become a list maker. It's not something that we take seriously. So, Kevin, as Spencer called it, our alternative investment guru, as I call it, our managing editor of alternative investments. Give us a little bit of a preview or maybe a little bit of background for those of us out there who don't know what exactly alternative investments means.
Yeah, absolutely. So, alternative investments are, could be essentially anything that falls outside of your traditional, stocks, bonds, ETFs, et cetera. These are typically tied to tangible assets. You got real estate, artwork, startups, you know, and any number of things that, can create value, increase in value. And these, while alternative investments are becoming more mainstream now. I mean, they're not new by any means. These are assets that institutional investors, billionaires have been investing in for for generations. But regulations have kind of limited access to the retail investor, and that's changed a lot over the last few years. So retail investors are now getting access to these same investments, and we've got some very innovative companies that are helping making that happen here.
Okay. And let me ask you this, Kevin. Why should as let's say I'm the voice of the individual investor today, why should I care about alternative investments? And I'll tell you my personal story. I'm a stock guy through and through. I'm a stock guy. Hit some nice trades this week, one on Netflix, one on SPY. Talked about those on our programming. I do have crypto exposure as well. That was sort of like my first foray out of stocks and ETFs that I've been investing in for, let's call it, the past decade or so. Why should I care about alternative investments?
So one of the main reasons, I mean, is diversification. Of course, alternative assets, have very little correlation with the stock market typically. Um, you know, real estate, for instance, the market could be down, but real estate is still producing income. It's consistent, and its value isn't affected so much by the overall market sentiment.
Excellent. I appreciate that context. And so with I guess let's just hop right into it. Let's jump into the list. Let's see our 2022 alternative investment list makers. We're coming to you live from our office in Detroit, Michigan. I love this camera angle. Let's check it out. We do have an ice rink behind us. It's a little early, it's a little cold, but maybe we'll get some skaters in there before our time is up today. But again, let's jump into these 2022 list makers. We're going to be looking at companies in 4 different categories, okay? Kevin talked about the universe of alternative investments being incredibly broad. We're going to be touching on pretty much each of the facets that we've seen major innovation in. The first one is going to be companies that give us access as individual investors to investing in startups, sort of like venture capitalists and high net worth individuals have been doing for quite a while. The second is we're going to be looking at companies that give us access to real estate deals. Right, I as an individual cannot go ahead and buy this building that's in the background right here on our screen right now, but now I can buy a fraction of it. Third, we're going to be taking a look at collectibles. This can be cars, wine, art, etc. And then the fourth group that we're going to be looking at are retirement solutions, right? How do I get access to some of these, not just in a cash investment account, but actually in a retirement account? And before we dive into those 4 categories and reveal the 2022 list makers for you, I want to talk a little bit about why this category specifically, this January list reveal that we're doing, is really near and dear to our hearts here at Benzinga. When we got Benzinga going, it was with the mission to level the playing field for the individual investor. Benzinga was born out of the Great Recession. It's been over 10 years now at this point. And what we saw happening is there was just a crazy amount of inequality of information between the institutions and the individual investor, right? We were getting news about financial instability weeks after the institutions already had a front run, and we said, hey, there's a better way to do this. We can really level the playing field, especially in the equity markets, for the individual investor. And the reason why we're so passionate about this alternative investing space, why we've built an entire team just to cover these alt investments, is because it's a furthering of our mission. These companies are truly making something accessible that none of us had, let's call it 10 years ago, 5 years ago for a lot of these asset classes. I think we're going to talk about Yield Street in a little bit here. I remember going to their office a number of years ago, and there was like a couple people in a WeWork, right? This world has moved so quickly, opened up so much access. It's absolutely incredible. We can diversify. I can get real estate returns. I can collect monthly rent payments out of an apartment building that I own a sliver of now. That's something cool. That's not something I've had before, and that helps me to diversify. But don't worry, I will still be making some stock picks, okay? So without further ado, let's dive into our first grouping, 2022 Alternative Investment List Makers. We are going to be looking at the firms that are giving us access to startups. All right. Startup category. Can we get the reveal of the first company to be a 2022 list maker? Start Engine. Have it up on the screen here. Kevin, give us a little bit of the breakdown on Start Engine.
Yeah, so Start Engine is, has become one of the biggest names in the startup crowdfunding space. So Start Engine, allows early stage companies, typically, startups of all cycles, onto its platform to raise capital from, retail investors. So, the average everyday investor can get on Start Engine, browse companies, and, a lot of investments, are as little as $100 even, to invest in these companies. And actually one campaign they had on recently, Nightscope, had great success, and they, I think, are actually listing on NASDAQ tomorrow. So just a great testament to the success that this platform has had. And they've actually been, as you can see on the screen here, obviously Michael Jordan rookie card is not a startup. So they've been kind of broadening into other alternative asset classes as well. Collectibles, they've got real estate, and some wine offerings too.
Yep, and shout out to great friend of Benzinga, definitely involved with Start Engine, Kevin O'Leary. And for the crowd out there, I left this note out. If you have not explored the alternative investment space, stay tuned. You're about to hear 18 different platforms. We have 18 2022 list makers. You're about to hear from all the options out there, or at least a wide breadth of them. But with that, let's get to our second list maker in the startup category. Can we get that on the screen? Republic. Alrighty, Kevin, can you give us a little bit on Republic, please?
Yeah, so Republic is, another, equity crowdfunding platform, similar to Start Engine, but they have, different, kind of a different variety of offerings. They've got a lot of, very innovative companies in the, in the crypto, the blockchain space. They actually just, closed a round of funding for a, I guess like a metaverse, a real estate fund actually. So some really cool, interesting stuff they do. They're, definitely, one of the companies that are, paving the way in the startup investing space.
Excellent. Thank you, Kevin. All right, so we're going through the firms that give us access as individuals to investing in startups. We take a look at the first two, Start Engine, Republic. Can we get the third company on the screen, please? There we have it. WeFunder. Kevin, tell us a little bit about WeFunder and what makes WeFunder special.
Yeah, so WeFunder actually helped pave the way initially for startup crowdfunding to non-accredited investors. They're the largest platform out there right now. They have the largest number of offerings at any given time, and they were actually involved early on in the process with changes that were made to regulations that allowed this type of access to investment. So definitely huge player in the space, making it possible for everybody else. And just, like I said, one of the, obviously the biggest, of course.
Excellent. And Kevin, while we're going through this startup category, I'm going to take a little bit of a detour. Can you just give us a little bit of information about the types of startups that are common to see on these platforms?
Yeah, so, everything. There's some really, neat companies, like I mentioned Nightscope earlier, autonomous security robots, for example. Jet Token is another one that may still be on Start Engine, a private jet company. Everything from, large companies that are looking to list, on a major stock exchange, all the way down to local breweries, distilleries, and just some really cool stuff to kind of get an idea of what's coming up in different industries, virtual reality, medical devices, whatever you can think of. If there's any particular industry that you really feel has a lot of potential, these provide some opportunities to find these early companies.
Excellent. And Kevin, I'm gonna, but before we dive back into the list, I'm gonna ask you one more question. What are some of the rules on investing in these startups? Are there limits that the companies can raise? Are there limits on the amounts that I can invest? Do I need to be an accredited investor in order to invest? Any sort of rules or context would be helpful.
Yeah, lots of rules, of course. But those rules depend on the type of offering. So, without getting too technical here, you've got 3 different types of crowdfunding offerings. One of the more common ones, in recent history has been Regulation D, which is just for accredited investors. But more recently, we've seen more Regulation CF, for regulation crowdfunding, and Regulation A, which opens this up to the non-accredited investor and brings down the minimum investment. So, depending on the regulation, there's different maximum raises. So, for instance, the Regulation CF has a $5 million annual maximum for a company, and then Regulation A has different tiers. And then the accredited investor only ones, pretty much unlimited.
Excellent. So, all right, I'm gonna throw this one out to the crowd. If anybody out there has invested in any of these alternative investments deals, whether it's a startup, we just went through the startup list makers. We're gonna be getting into real estate next, then collectibles, etc. But if anybody out there has invested in these deals, will you throw me a 1 in the chat? If anybody hasn't invested but is curious or interested, throw in a 2. And I guess if you have any other comments, we always appreciate those too. I'll speak from my personal experience. Again, I'm a stock guy through and through. That is my passion, the love of my life. We might get a little bit of time out of Spencer to talk some stocks later today. But I recently made my first 2 alt investments. So I'm just starting to get into it now. And if you're just joining us, let me give you a little bit of the lay of the land. This is the Benzinga 2022 Listmaker Series. This is where we are showing off to all of you out there, here are the companies that you should be paying attention to from an investment standpoint. Today, we're starting with a category near and dear to our hearts, what we think is one of the next major frontiers of investing, alternative investments available for the individual. We just went through the platforms that are giving us access to startup deals, right? Something that venture capitalists have been doing for a long time now. Next, we are going to be moving into real estate, right? How do I get access to real estate? If I want to own this building that's behind my corner right here, I cannot go out and raise the $50 million to do that myself, but can I own a slice of it? Now I can. Next, we're going to be moving into collectibles, and then we'll be moving into retirement solutions. And shout out to Fourth Wave in the chat. Doesn't know what we're voting on, but 2. He agrees. So, all right, Kevin, you just took us through the first grouping of our alternative investment list makers. That is the startups. Next, now let's get us kicking over and look at the companies that are giving us access to these real estate deals. And Kevin, let's start by asking you this. I thought that was some very tranquil intro music. Do you agree?
Yeah, absolutely. I feel relaxed.
Very tranquil. I might just have to get that 2-second loop and throw it on background to help me sleep tonight. But all right, Kevin, we're moving into the real estate category. Tell us about Lex Markets. Congratulations to Lex Markets for being the first one in the real estate group to become a 2022 Benzinga Listmaker. This is a badge of honor for all the companies on here. What do they do? How do they help us as individual investors?
Yeah, so Lex Markets is one of the newer platforms in the space. So, as we've seen in the startups, those platforms are all available to non-accredited investors. Real estate's a bit different. Most crowdfunding platforms for real estate are still accredited investors only. especially in the commercial real estate space. But Lex Markets is really changing that up. So they're bringing, some of the same types of assets that are only available to accredited investors, to, institutional investors, to virtually anybody with, low minimum investment. So I think it's $250. Get on the platform, you can buy shares in a property, and they even have a secondary market, which is really cool because real estate is inherently an pretty illiquid investment. It's long term. So if something comes up, you need to get your cash back. Very limited options. So Lex has the secondary market, so you could actually list your shares in a property for sale to another investor.
Yeah, that's absolutely interesting. Alrighty, so first one that we took a look at on the real estate alt side of things, Lex Markets. Can we get the second list maker, please? I see producer Spencer in the background working on pulling up that second list maker for us. He's typing furiously. It's not Republic.
It's Republic, actually. Oh. It is.
So Republic makes it twice?
It twice, yeah.
What? So Republic, if you recall, we just saw in the startup category. How is Republic in the real estate category as well, Kevin?
So yeah, they actually they moved into the real estate space, primarily launching what they called city funds. So you could invest in these specific city funds. One of them I think was Austin, one Miami. So if you liked just an overall market, you could invest into this fund that diversified across different properties of those markets. As of right now, those funds are all are closed, but through that momentum they built with those, they added, a lot of other real estate offerings to the platform. Some really unique stuff that you're not going to find on your typical real estate, crowdfunding sites. And, most of these, again, are available to non-accredited investors. Some offerings are accredited only. Just depends on the regulations they're using.
All right. So there we have it. Republic making it into a couple categories. 2022 list maker. And again, for anybody who's just joining us right now, we're going through the companies that Benzinga is recognizing as really moving the frontier and giving individual investors access to real estate deals. We took a look at the first two, Lex Markets, then Republic. Producer Spencer, can we get the third on the board, please? There we have it. Red Swan. Kevin, tell us about Red Swan.
So Red Swan is one that, I think our audience should really get behind. They are, kind of, pioneering a really new, space in real estate investments through tokenizing properties. So they refer to it as blockchain real estate, digital properties. So typically you buy, you're buying securities. You're buying shares of, a company that owns a property. What Red Swan is doing is turning each, asset on their platform into its own cryptocurrency. There's, a ton of benefits to that. It's not just a gimmick. It really simplifies the whole fundraising process, and it also adds a liquidity option to investors to be able to sell those tokens, within the target investment period of these properties.
Excellent. Thank you, Kevin. Question out of the chat coming to us from David Wilson. Do you know if any of the firms that we've talked about take non-U.S. investors?
I don't know which ones specifically. I know a lot of depends on the regulations. But yeah, some on the list they do.
Okay.
Yep.
Excellent. Let's keep moving through this real estate category. Producer Spencer, can we get the fourth list maker on the board, Arrived Homes? Congratulations to the Arrived Homes team. Kevin, tell us a little bit about this one.
Yeah, so Arrived Homes is another one of the newer platforms to the market, and what they actually they go and they acquire really like nice high quality rental properties, and they securitize them and sell shares to the investors on their platform. And this is another one open to non-accredited investors where you can, browse the properties. So you can actually buy shares in a specific rental property right now with a minimum investment of $100. So, I mean, rental properties, obviously one of the more popular real estate investments. And so this is just a really easy way for somebody to, either get their feet wet in real estate investing, or if they are just looking to add this type of asset to their portfolio, Rived Homes is an incredible option.
Alrighty. Let's keep it clipping through the real estate category, and I want to throw this one out there to the crowd watching us. We saw a lot of people say they were interested in getting into the alternative investment asset class, or they already are. What type of deals are you interested in? I'm curious. Is it startups? Is it real estate deals? Is it collectibles? Something beyond what we're thinking about? Let us know in the chat. I'm curious where everyone's at. The first couple deals that I did were real estate deals. We're going through the real estate category. Can we get the 5th list maker up on the board, please? Ground floor. Kevin, tell us about ground floor.
So ground floor provides, a different way to invest in real estate. So, the platforms we've talked about so far are equity. Ground floor is actually, they got kind of almost two different companies. So they make hard money loans to real estate investors and builders who are either, building a home to sell it or, flipping it. And so what they do, they make these loans and they securitize these loans and put them on their platform for investors to buy shares of individual loans in these properties. And I mean, at only $10, $10 minimum investment. They add, typically maybe 15 to 20 new loans a week. So there's a lot of room to diversify across different properties.
And will you tell us really quick, Kevin, what a hard money loan is?
Yeah, sorry. So a hard money loan, it's a, not a traditional bank loan, right? So these are loans that people are, that might not, qualify for a normal mortgage because it's a distressed property. It needs a lot of repair, but it has, a lot of after repair value. So it's common for somebody who flips houses to use this type of financing short term. So it's a higher interest loan. A lot of these could be, 8, 10, 12, 15%, but they have terms that are going to be 6 to 18 months. So then they can either sell their property to take out their profits or have them refinanced once, they, kind of meet normal, lending guidelines.
Excellent. Thank you, Kevin. So again, for anybody just joining us, we're talking about the companies giving us access to real estate deals. We are staying in the real estate category. Producer Spencer, can we get the next list maker up on the screen, please? Motive. Kevin, what is Motive doing out there for the individual investor?
So Motive is actually a REIT. I know a lot of people are probably familiar with your typical publicly traded REITs. Motive is a public non-traded REIT. So, they operate the same as, any other REIT or, real estate investment trust. They own, I think Motive's got a portfolio of around, $500 million worth of real estate. So investors buy shares in that portfolio essentially. But the big difference is these shares aren't traded on, on a major stock exchange right now. So, their price has, more protection, I guess, from, the stock market if things are down, instead of.
That's interesting this week. I'll give you that much.
Yeah.
Right? We get a little bit of volatility this week. It definitely makes it interesting.
Yep. So, yeah, it's another way to invest in real estate. They just kind of, instead of choosing a property, you're kind of investing in a whole portfolio.
Perfect. Alrighty, producer Spencer. I know I'm asking you to go fast, man. But can we get the next company in the real estate category? CrowdStreet, company that I know very well. Kevin, tell us a little bit about why CrowdStreet is out there helping the individual investor. How are they doing it?
Yeah, so CrowdStreet was, one of the first real estate crowdfunding platforms out there. And, Luke, you said something about, being able to buy, this building we're in or buying a slice of it. CrowdStreet is the platform that you would go to, to buy that type of asset. The deals on here are, are big deals, that have been, reserved for, typically, hedge funds, private equity firms, really big developments that, have, opportunities for, some outsized returns.
Excellent. All right, guys. We are down to the final 2 list makers in the real estate category. Again, these are the companies that Benzinga is recognizing for pushing investing for the individual investor, the next frontier. We work our butts off every single day to do it in the stock market. We're moving into the REIT space. These are the companies making deals accessible. If anybody's seen anything that jumps out as especially interesting, put it in the chat, like the stream. Let's keep going. Again, this is something you should absolutely care about because we have access we haven't had before. Next one up on the board, we have Acre Trader. Kevin, tell us about Acre Trader.
Yeah, so Acre Trader actually allows you to invest in farmland. They've had offerings, globally, actually. And interesting, like I personally had never really thought about investing in farmland until I watched a webinar that Acre Trader put on one of their offerings, and it's one of the, I guess one of the most stable, safest real estate, asset classes, available, especially as, we've got a growing global population, we've got shrinking farmland, the demand for this is really growing, and it's, been really getting a lot of interest from investors lately. So yeah, Acre Trader is, the first to, bring this, this type of investment.
Excellent. I think the farm move is sort of interesting. Shout out to Kevin Simon in the chat talking about the Red Swan CRE offerings. And Richard Calloway saying that we picked a good topic. Spencer Israel specifically did. Alrighty, everyone. We are down to our last list maker in the real estate category. Don't worry. I'll give you the full rundown afterward, and somebody help me out in the chat when I list all the firms. Drop them in there. But we have Cadre. Kevin, tell us what is going on with Cadre.
Yeah, so Cadre offers, a couple of ways to invest. So, we talked about, buying shares directly into an asset or getting into, a whole portfolio. So Cadre kind of has both these options. They have a managed fund. So if you just want to add real estate to your portfolio, not worry about the property, they have that fund investment. You can also, browse individual deals. But one of the things that they were the first to do was bring on this secondary market for its investors. So they have, I think it's quarterly kind of liquidation windows or secondary windows where investors can put up their interest in these properties for sale.
All right, and what is this? I mean, I'm hearing producer Spencer, my ear set. We have one more in the real estate category. One more to recognize in. And again, everyone, I'm going to be running us back down through the list. We're going to talk in just a second here why you should care, why I care as a personal individual investor. But Yield Street, Kevin, tell us what Yield Street is doing.
So Yield Street is a lot more than real estate, but we had to put them somewhere, right? So this real estate made the most sense. So Yield Street is, across the board alternative investments. You can invest in portfolios of, consumer debt. They have structured notes, art equity funds. At one point they even had, I think, an offering where you could buy shares of a portfolio of motorcycle loans. And real estate is, of course, a big chunk of their offerings as well. All different types of asset classes in there.
Excellent. Thank you, Kevin, for taking us through it. Again, everyone, if you are just joining us, this is our first List Maker event of 2022. This is where we recognize the companies that are really making markets better for all of us. I say us because I'm an individual investor. You are individual investors. These companies are moving the next frontier. It's a major badge of honors for these companies to make it onto the Benzinga lists. I'll give you a quick recap of where we are and then where we're heading during this segment. So we talked first about the companies giving us access to startup deals. They were Start Engine, Republic, and WeFunder. We then moved into the companies that are giving us access to real estate deals. We had Lex Markets, Republic again, Red Swan, Arrived Homes, Ground Floor, Motive, CrowdStreet, Acre Trader, Cadre, and Yield Street. We're down to our last four list makers, guys. And why should you care about these? I'm a stock person personally. I have almost 100% of my assets tied up in stocks. I want to diversify. I want to look for other places of outsized returns, maybe places of less liquidity. So that's why I care. Suggest everybody explore the category that isn't already in it. Next, we're going to list, we have three list makers in the collectibles category. Okay, this is really unique. So why don't we roll straight into the collectibles category? All right, we have our tranquil intro music. We're in the collectibles category. Kevin, first list maker we have, rares.io. Tell us about this one.
So yeah, Rares is one of the the more interesting alternative investment platforms out there. It was started by former NFL player Jerome Sapp, and where he saw this opportunity to give people the ability to invest in sneakers. So obviously not just any pair of shoes. These are rare, collectible shoes. One pair that they had on there, I think, was the pair that Kanye West wore for was the Grammys. I think it was the 50th Grammys. So
Wait, was that the one where he interrupted Taylor Swift? We need a rule check
know.
out of the chat on that one. But all right, that's an interesting one. First one on the list, rares.io. Can we get the second collectibles company, please? Masterworks. Tell us, Kevin, about Masterworks.
Masterworks, yeah. So this platform lets you invest in iconic artwork. So we're talking Pablo Picasso, Andy Warhol. I mean, multi-million-dollar paintings. So Masterworks acquires these paintings and sells shares to investors, and then also has the the secondary market as well. So I mean, these are obviously, they're buying paintings that they see increasing in value over time. They have a target hold period. Once they find the right opportunity to sell the art, they do. Investors get to share the profits on that.
Excellent. And Kevin, we have one more company in the collectibles category. Producer Spencer, can we get that up? VinoVest. What is VinoVest giving us access to that we don't normally have?
So yeah, VinoVest gives access to fine wine. And unlike the other platforms on here where you're buying shares of something, with VinoVest, you're actually getting a portfolio of your own wine. I mean, at any point in an investment, you could take possession of these bottles, drink them. But what they provide that the normal investor doesn't have is for one, access to releases of wine that just you or I couldn't go and get, and the knowledge of which ones to actually buy. What wines are likely to increase in value over the next 3, 5, 10 years.
Excellent. Yeah, the wine play is interesting. The art play is interesting. I like art. I buy some $50 Target art. I'd like to invest in some Picasso art. I haven't yet, but all right, that's interesting. So, all right, I'm going to keep us moving. Again, everybody, we are recognizing our list makers in the alternative investments category. Huge badge of honor for these companies. We should be proud as individuals that we now have access to a lot of these deals. The last group that we are going to move into are the retirement solutions. We have 2 retirement solutions out there. Let's move into the category, and let's get the first retirement solution on the screen. All right. Altura, tell us about this one, Kevin.
That's actually Alto IRA.
Oh.
Not one word.
All right.
So
I'm going to get fired.
a lot of people don't realize is you can actually add alternative investments to your retirement account. So it's not limited to just, stocks, mutual funds, et cetera. Through a self-directed IRA, you can invest in, a whole range of assets. So Alto IRA actually, is, that solution for a self-directed IRA, and they partner with, I think it's over 75 different alternative investment platforms, like most of the ones we're talking about today. So you can, kind of get those tax benefits through investing through an IRA, and get better diversification overall to your retirement portfolio. And they actually have they have their crypto IRA too. So you can invest at, I don't know what the number is now, it keeps growing, but I think it's over 100 different cryptocurrencies through it.
Lot. All right, Alto IRA, the first one in the retirement category. Last company we have in the retirement category. Last list maker that we have, Rocket Dollar. Kevin, what is Rocket Dollar doing for the individual investor out there?
Yeah, so similar to Alto, so they provide a way to invest in alternative assets with your IRA, but they do it differently. So with Alto, you invest through one of their partners. Rocket Dollar actually helps you set up like an LLC or a trust for your IRA. So then you can invest in any eligible alternative assets that you come across.
Excellent. And with that, we have our list makers, our 2022 list makers, alternative investments category. 18 companies on the board. Congratulations. Huge badge of honor for you. And we appreciate the work that you are doing in making markets accessible for us. I see Spencer back up on the screen. What's going on, producer Spencer?
We need a company that provides access to stopwatches, and then we need to get you two a stopwatch. That's my biggest feedback right now. But Kevin and Luke, thanks a lot for taking us through the list makers.
And Spencer, I do have two more segments that I want to do real quick. Oh my
gosh, you're killing me here, Luke.
I'm just kidding.
We have to move on to our keynote speaker of the day. I'm going to bring on Justin Renfro, the Senior Director of Growth at WeFunder, one of the companies that was on that list we just went through. And we're going to talk about, why does WeFunder exist? Reg A, Reg CF. What does that market look like right now? Without further ado, let's bring on Justin Renfro, the Senior Director of Growth at WeFunder. Justin, how we doing, man?
Good. How are you? Thank you for having me.
Thanks for bearing with me through that one. I saw you lurking in the background. So let's get right to it. We gave a high level overview of WeFunder and what you all do, but maybe we can hear it directly in your own words. Why does WeFunder exist?
Yeah, so we were founded on the premise that we wanted to democratize access to capital, both for startups and for investors. For a lot of time, investing in startups was siloed. It was exclusive. It was hard to access, partly because it was kind of focused on accredited investors were the only ones that could participate. The Jobs Act of 2016 opened up startup investing for accredited and unaccredited investors. And then, with WeFunder and Reg CF in general, we're a technology platform that is designed to connect startups and investors. So opening up access, kind of removing geographical barriers, and giving investors around the world the ability to invest in startups that they believe in, that they see potential in.
Like, what are can you give me some examples of some of the kind of companies that we're talking about right now?
Yeah, so I would say the best product market fit and the kind of sweet spot for WeFunder are technology startups that are in the seed to Series A stage that are raising capital from angel investors. Our average round is about $500K, but we've got a $50K to $5 million range in terms of the types of deals that we typically see.
Wow.
But most of the companies that are fundraising on our platform are this is their second or third round of financing. They've got some traction and they're looking to kind of level up, go from step 2 to step 3 in terms of the funding life cycle of the business.
We're talking about crowdfunding. I would just love to get your thoughts on just the state of crowdfunding right now. It's not like a new idea, but I have a hunch that a lot's happened in the last couple of years. We tend to see great change whenever there's a big disruption like the one we got from the pandemic. So I'm just curious, like what is the market, or maybe you can give us what did the market look like before COVID, and what does it look like now? How has it changed?
Yeah, well, I think the biggest kind of catalyst for change was in the SEC regulations of our industry.
Okay.
In March of last year, there were a couple really big pieces of legislation that just made equity crowdfunding slightly more friendly to companies. Primarily, the limit previously was $1 million, and that was increased to $5 million. The second big piece of regulation was the way in which these raises showed on the cap table. So previously, all the investors that came in through a regulation crowdfund would show up on your cap table, which was unattractive to a lot of companies. Now, all those investors are pooled into an SPV, a special purpose vehicle. So it's one line on the cap table. It's much cleaner. So with the increase of the cap and with the construction of the equity kind of crowdfund raise, it attracted a much higher kind of caliber of companies. Better companies are exploring regulation crowdfunding as an option. So a few months ago, we hosted a fundraise for a company, Mercury Bank, that was coming off a $135 million Series B, valued at 1.4 billion, and they opened an additional 5 million to the crowd. And that is really exciting for us, that unicorns, companies that are valued at $1 billion plus, are now exploring equity crowdfunding as a viable option, kind of opening up the opportunity for the crowd to participate alongside angels.
It's interesting because I wouldn't have thought of a bank, you know what I mean, as like, you know, a company that would go to crowdfunding. You know, you think about like startups, like I don't know, a technology company, but as you said yourself, there are more companies on the platform. I mean, like what else we got here? Because a bank seems to me like it's highly regulated, but it was a success.
Yeah, well, I mean, the real benefit for Mercury coming to WeFunder was they could have their customers invest in the company, which is great marketing, great customer engagement, a huge value proposition for them to be able to offer the opportunity for their customers to invest in what they're building and invest alongside, really high quality VCs. When you look at, our platform hosts hundreds of raises right now, hundreds of companies that are raising capital, and you see quite an impressive range. You've got real estate, you've got tech companies, you've got energy, you've got sciences. So it's kind of whatever you're interested in. Kind of the beauty is that, you're looking at it through the lens of an investment, but you can look at a very wide range of different types of companies that are offering that opportunity for investors to come in and participate.
Like, who are the investors? Like, typically, are we talking, everyday people, or is there a variety here?
Yeah, I mean, we've got over 1 million investors on our platform. It's a global audience, and you're looking at, across the entire spectrum. Our average investment is actually $1,100, and one of the biggest benefits is the going kind of like philosophy for angel investors is you're hoping that one of your bets pays off the rest of them. So you're looking for, you're swinging the bat, looking for big exits and big returns. And the going notion is to make 30 bets. And it's like, well, you can make $30,000 bets and one is going to pay off the rest. And it just makes it much more accessible. Whereas, previously it was like a $25,000 floor. Now it's, there's no floor. So it's much more accessible to the general population to be able to participate in angel investing.
That sort of answers the big question I had, which is like, how should I think about these, like an investment here? How should I think about like, buying a stake and taking a bet in one of these companies? I mean, you kind of just already answered it, but in relation to the stock market, for example, which, you can have a long horizon, you can have a 1 hour horizon or less, right? On a trade. Like how do you think about this stuff?
Well, I think this is not a 1 hour bet. These are 5 to 10 year horizons typically, where, it's like 5x in 5 years. Can this company exit and produce a 5x return for investors over 5 years? That's a good baseline. But again, if you go to our platform, you've got companies that are raising that are a little earlier, that are, $5 to $10 million valuation on the company. And you've got companies that are raising on 100 million, or in the case of Mercury, a $1.4 billion valuation. So you can go where you're comfortable on the spectrum. If you want to go earlier, where the upside is higher, but it's a longer and bigger bet, or you can go with companies that are further along, that have more traction and a higher valuation as a result.
Right. And then are you finding like people will look at an investment, is this purely a financial thing? Or you mentioned the bank that they made it so that their customers, people who were already involved with the bank, could invest, but is this just like a financial equation, or do you find people are attracted to companies that they know, that they already use?
Yeah, I mean, I think that every investor kind of looks at it through their own unique lens.
Yeah.
You're looking at the team, you're looking at traction, you're looking at the market potential, you're looking at kind of the price. There's a lot of different lenses by which you can look at any given investment. But I think the most kind of basic foundation is you're looking at team, you're looking at traction, you're looking at market as kind of those indicators as to where you should make your bets. And those are all articulated, pretty extensively for any given company on the WeFunder website. A company will create a campaign page, which has, a short pitch video, a pitch deck, financials, all of the different aspects of, of those kind of core components of the merits of the investment and kind of, what they've done previously and, why they're raising capital and what they're planning to do, in the future.
The prevailing sentiment in the chat seems to be is this available to international investors? And you've already clarified that is the case.
Yes, that is the case.
Okay. Question from Now We Know. Is there a mandatory hold period? Great question. Now We Know.
So right now, there's no secondary market for these types of investments. So you're really looking for an acquisition or an IPO for a payout. But so there's no mandatory hold, but there's these are not super liquid assets.
Yeah, that also speaks to my next question, ironically, which was like, what are the risks that people need to be aware of before they go into this? This is not the same as buying a company on public markets. This is not that. This is the kind of thing that angel investors do, but the rest of us don't have the experience for it. So what risks should we be aware of here?
Well, the biggest risk is, you're investing in early stage companies, and these are longer kind of a longer investment horizon. These are bigger bets, bigger payouts. So riskier bets, bigger payouts. But generally speaking, I think you should look at it through the lens of you're making a lot of bets. You're investing in a lot of companies, hoping that one takes off, you get 100x return and it pays for, a bunch of the bets that didn't pay out. So that's kind of the philosophy is just like, don't invest what you can't, invest what is, reasonable to you. And just know that these are bigger swings.
What sort of protection or like regulatory infrastructure is there for investors, but also for these companies? Again, it's different being a public company and a private company, which these companies are.
Yeah, I mean, the SEC and FINRA are, this is a heavily regulated industry. Companies have to jump through a lot of hoops to be able to offer equity to the crowd. There's a very robust due diligence process, as well as a kind of like, there's a lot of boxes you have to check to be able to do this. So I feel that there's decent protections in terms of, it has to be a legitimate company that has the core foundation of a real company to be able to participate and offer equities in this way.
So I can't just get like Spencer Co. on WeFunder. There are hoops to jump through.
It depends. Maybe Spencer Co.'s super legit, but yeah, you're probably right.
Yeah, it's not legit. I made it up just now. So okay.
Right.
So like there are regulatory hoops, but then there are also like WeFunder hoops, right? You won't let anybody.
Well, investor protections are important. We want to make sure that we're offering legitimate investment opportunities to the crowd, and so every company goes through a pretty robust process in listing on WeFunder.
I'm curious, when you have conversations like the one we're having, or when you talk to people that may not even know that this kind of thing is available, what is like the biggest thing that you typically hear, the biggest whether it's a question or a piece of feedback or a concern, or what is the most common refrain you get when you talk about startup investing for everybody?
Well, I think, again, these are early stage companies. So the due diligence and kind of what you look for in any given investment, it's a slightly different lens. I think that the beauty of startup investing is you're really close to the action. A lot of our investors are reaching out to the founder. There's a dialogue with the founder. You're like in the weeds of kind of like the startup journey. And I think that's a very exciting and fun piece of the equation, where it's like, hey, there's a lot of these dynamics that you can evaluate. And there's an open opportunity to have dialogue with these founders to kind of, be a part of the action and be a part of the kind of exploration of that early stage.
Will these companies, will they do like raises in like, like campaigns, or is it like an ongoing thing, or does it depend on the company?
Yeah, it depends on the company. A lot of companies are really successful utilizing this method of fundraising. So they'll continue to, circle back and continue to fundraise. I talk to a lot of founders that are like, man, if I can raise the capital I need from the crowd, I'd prefer the crowd over VCs and angels. That a lot of times, especially in middle America, if you're off the coast, those ecosystems aren't super friendly, and angels and VCs are, predatory might be the wrong word, but I think that the crowd is a little bit more more founder friendly in the sense that you're not giving up a board seat, and you're having a little bit more kind of like engagement from a larger community. I think it's a really unique way for companies to fundraise.
One of the reasons I'm really bullish this is because we've seen this in the last year, frankly, with the stock market, with stocks like AMC and GameStop, where the stock to a lot of people became more than just the stock. It meant more to them. It was not just letters in their account, or not.
Exactly.
It was more to them, and,
Right.
and these companies can be more to you than just a name in your account somewhere, right? And
Correct.
that like psychology lends itself more, frankly, to angel investing than it does to the public markets.
That's exactly right. And I kind of touched on this earlier, where it's more up close and personal, where you're part of the action. You can see the startup journey. It's more personal and a richer experience, in my opinion, to kind of be along that founder journey and kind of see what's happening in the moment in terms of building these startups. I think it's a very fun experience, and a big part of it is looking at it through an investment lens. What's going to what do you think has the best opportunity to have an exit? But I also think there's a philosophical element where it's like, what do you care about? What are you passionate about? What do you want to see in the world? What are you interested in? There's more kind of connection there.
Is there anything that we didn't cover, Justin Renfro, Senior Director of Growth at WeFunder? Is there anything that we missed that you want to hit on before we go? Any questions from the chat?
I think I joined. I really enjoyed the programming. Before I joined, and we were talking about all these different assets. I think the best part of WeFunder is the range of different types of companies. You've got early stage, you've got late stage, you've got all different industries, you've got all these unique kind of rich stories. So I think it's a very cool experience to go and like poke around and research and see what are all the different types of companies, what are they doing, how are they framing it, what is kind of that storytelling and that connection to the narrative is very rich and has a lot of range. I think that's probably my best takeaway.
Justin Renfro is the Senior Director of Growth at WeFunder, joining us today for our keynote as part of this Listmaker series show. So, Justin, thank you for hanging out with us. I know you woke up early. I appreciate you coming on.
Thank you for having me.
Very much. Look, I will be taking some time out of my weekend and doing some browsing.
I appreciate that. Thank you again for having me.
All right. Thanks a lot, Justin. Hey, go ahead and if you could be so kind and smash that like button, I'd appreciate that. It can't be a show on Benzinga if Spencer doesn't grovel for likes. That's like par for the course, right? Hit the like button, hit subscribe, do all those things that you do. In case I didn't make it clear, if you have any questions at all in the chat, please don't hesitate to ask. We do this. I mean, it's fun for me, but that's not why we do it. If that was the only reason, then we would do other crazy stuff. We do it because it's educational, and this is like this is serious. Like I take this very seriously, right? I mentioned this off the top. Inflation right, is a thing. Rising rates are a thing. There are other assets out there that demand your attention. Please take this seriously. It's fun, but I mean, come on. Let's take it. This is important stuff, and we can have fun, but it really is important. It really is important. All right, so we're running way behind schedule, so I apologize to all of our guests. Let's do this. I may decide to call an audible here. Our next segment is going to be an explain like I'm five segment with with Crowd Street. I have Ian Farmigle from Crowd Street here. I also have Chris Pachinger from Crowd Street. This is going to be a quick segment. We're going to just answer some basic questions about the structure of the real estate market. Ian, are you good for me to bring you on right now? Can you give me a thumbs up? You're good. Excellent. All right, let's do our first explain like I'm five segment of the day. Hey, look at that.
Right.
Ian, did I get your last name right, Farmigle?
You did. Yeah, Farmigle. It used to end in an I, now it ends in an E, so it's a little bit hard to pronounce.
Well, there was a lot of debate last night. We found multiple pronunciations online, so we were debating is it far? Anyway, I don't want to get into that. Okay, Ian, explain to us briefly the structure of the real estate market. Like we got commercial, we got residential. There's a lot of great resources on the Crowd Street site, but just overall here, can you explain it like we're five?
Yeah, Spencer, happy to. So, well, first of all, the first part of this answer is like the real estate market is huge and it's structured in like tons of different ways. So I'll just kind of talk about our small corner of it. Yeah. In that we focus on our marketplace in the private markets in predominantly equities. So this is kind of like imagine like a massively scaled up version of you and your friends deciding to go buy a piece of property together and partner on what you're going to do with that, right? That could be as simple as like, hey, it's me and three of my friends. We're going to go buy a rental house together and we're going to rent it. We're going to fix it up. We're going to sell it someday. But in our case, we're doing that with, multifamily projects, industrial business parks, hotels, retail shopping centers. And instead of, $500,000 or $800,000 for a house, we're doing that at $50 to $150 million for a major per piece of commercial real estate. The difference between what I just described and kind of partnering with your friends and what we also do is that you're investing passively with operators and developers around the country who do this every day as their business, have been doing it for years. And, they might have $1 billion portfolio. So they're making that investment available to you as an individual investor. Like a lot of stuff that you're talking about today, this is all about democratizing access to private investments. And we're just doing it through, real estate private equities.
And so like you sort of already said it there, but can you go through it again? We're talking apartments, we're talking hotels. Like what is the commercial side, the commercial real estate side of this? What are all the things that includes?
So right now, kind of give or take about half of everything we do is going to be in the residential space, be it a multifamily, so an apartment complex that's located in a city. Doing one in Charlotte, for example, could be in Dallas, it's going to be probably in a relatively major metro. That's going to be 200 or 300 units. It's going to be, we could be building it, we could be buying it and fixing it up. So it can take multiple forms. So that's probably about half of everything going on out there. Some sort of residential project. Could also be student housing. We're in a student housing development at Clemson University right now. And then from there, it can get into forms of different, commercial, we can talk about office deals. Yeah. They can be suburban, they can be downtown. We've been in a lot of grocery anchored shopping centers around the country. And then hotels, a good example. We invested with a group called Buccini Poland Group in the Virgin Nashville Hotel, like in Nashville. So right on Music Row. So we were in that project as well. So, it takes a lot of different forms, but it's all equity at the end of the day.
And as the investor, I'm getting my return from the rent, right?
Yeah. You're getting your return in two forms. The first is that net cash flow from the property, right? So they're gonna buy it or build it, and then they're gonna lease it up whether it's already leased or they're gonna stabilize it. Then it's gonna produce, the goal is, hey, that's gonna produce cash flow after we pay debt. The net cash flow that's left over after all of that is then eligible to be distributed to the partners, because that's what you are. You're a limited partner, right? You're not the developer, they're the general partner, right? So they're kind of like, hey, I'm the captain of the ship. We're going to drive it, but you're on board. And so the investors get to participate in that net cash flow coming out of the project. And if we look across the entire marketplace right now, our portfolio, that leverage yield right now is about 5.5% across everything, including development to stabilized. The other part of the return is essentially when they sell the project, right? They're going to hopefully build it for $1 and sell it for $1.50 down the road. When they sell it and then they make a profit, that's when the investors will probably see about half or more of the total return.
Awesome. Any basic questions from the chat, please? There's no question too stupid to ask. Here's one, Ian, and maybe we can wrap it up with this. How does real estate typically, as an investment, typically behave in an inflationary / a rising rate environment?
Good question. Data over the last, if you look across the previous inflationary periods, and particularly if you go to that decade of the 70s to early 80s, when we were in a massive inflationary period, the answer is real estate typically outperforms. You can see that the private real estate and public real estate in the forms of REITs, they outperform the S&P over that period. There's groups out there like Green Street who've done some good studies and research has showed the kind of those returns. But the answer is, net real returns that have beat the S&P over previous inflationary periods.
There we go. Ian, I'm going to move you backstage for 1 second, and I'm going to bring you back on. So stay tuned. Don't go anywhere, or do, but just come back in like 30 seconds. Let's move on to like the thing I am very excited for coming up right now with this panel. Okay, we're going to bring Ian back. We've got executives from 3 different real estate investment companies. And they all do a little bit tackle the space in their own way. We're going to talk to them at a high level. What the heck is going on right now in real estate? Like you've seen the headlines. Housing market is mooning. Down payments are ridiculously unaffordable right now. Speaking from experience, rates are going up. What does that mean for the real estate sector as an investment or as a home buyer, maybe? So let me bring on Kevin Vandenbos, who again is sort of our like alt investment / real estate guru. Is Kevin here? I think he's here. Kevin, don't leave me. Kevin, are you here?
Yeah, I'm here.
Hey,
I'm here.
What's
I'm
up,
not going
man?
to leave anybody who calls me a guru behind. Don't worry.
Hey, good. All right. So Kevin, we just heard from Ian, and we're going to bring him back on here right now. But tell us who else we have on this panel. Then I'm going to let you run with it.
All right, definitely. Thank you. First, I want to say, real estate is and always has been my favorite asset class. So I'm, super pumped to be, here to have the chance to talk to this panel today. First we have Ed Nwankity. He's the founder and CEO of Red Swan. We're bringing back Ian Formigli, again, the CIO of CrowdStreet. And we also have David Vincent, who is the investment product specialist at Cadre. Welcome, guys, and thank you. I want to kick this off and, just ask, I want to get you guys' take on, what has been the biggest, theme in real estate, in the real estate market the past 2 years?
Kevin, where do you want to start?
Yeah. Sorry. Yeah, go ahead, Ian.
All right. Hey, well, pleasure to be on the panel with the other participants. Okay, so if you want to talk about theme, I think one theme that kind of transcends across a bunch of different property types is that what we've seen is what we call this cap rate compression. For those who aren't familiar with commercial industry as much, what we do is we say cap rate, we take the net operating income, we divide it by the value of the asset, whether it's the purchase price or the appraisal value, and that gets you your cap rate. So we used to see these yields, I mean, that's what it is an unlevered yield on the asset. They used to look like 5% and 6% in previous years. Now they look like 3.5%, and particularly for industrial and multifamily. So that's been one major theme. Before I pass it to the others, but I want to point out, I think to me, there's a couple of huge stories that have been in the commercial real estate industry over the last couple of years that have been I just haven't seen stuff like this before. And it all was pandemic driven. One was the hospitality industry. I mean, got leveled in April of 2020, right? We've just never seen assets go from 90% occupied in a downtown city to essentially zero, absolutely empty within a matter of a month. So that created a whole bunch of stuff in the hospitality industry in terms of, how they're going to approach the industry coming back. So it's been super fascinating to watch. And then I think the other thing is, look at the office market. Again, pandemic driven, still in the phases of figuring it out, but office is going to look a lot different in the years going forward. It's still in that transition phase, but it's fascinating to watch how office is going to kind of retool itself. I do think you're going to see a lot more people back in the office in the next couple of years, but I think it's going to look different than it looked, pre-pandemic.
Hey, thank you. David, what are you seeing? What have you found to be the theme?
Yeah, well, I'd say certainly agree with everything that Ian just said, and to maybe put a brighter spin on things, some important themes that we've been paying attention to here at Cadre that I think are pretty relevant to the market right now, especially driving that cap rate compression, is greater mobility. And it's a theme that I think was going on before the pandemic and has really just been hyper accelerated over the past 18 to 24 months. Is people moving out of big cities and wanting to move into smaller cities where you have a better quality of life. And it's challenging because if you want to live in Denver, if you wanted to live in Austin and move out of New York City, you got to find a job, right? So it's a chicken and the egg. And more what we've been seeing is also companies are moving their headquarters or opening up remote offices in a lot of these more secondary type cities. And so as people are moving there, the jobs are following the people. As the jobs are moving in, more people are attracted. And so you're seeing tremendous growth opportunity in a lot of cities across the country. I mean, places like Tampa, Charlotte, Nashville, Austin, certainly. And we're seeing every day, it feels like more and more companies are announcing big job moves into these cities. And that's been a big driver on the real estate side for, multifamily apartments, well-located, high quality assets. There's a ton of demand, and that's a good thing for investors, right? And it's also impacting the office market, right? So in some of these markets, you're seeing new companies coming in, they're either building new offices or they're renovating existing offices. And, to Ian's point, it's really fascinating to watch because we don't know what the office world is going to look like a year from now. And we're still figuring it out. And that is exciting. And then the other really big trend that I think has had an impact on the market over the past 2 years has been the continued move towards e-commerce. As retail has suffered a lot of pain over the years, and something that a lot of people have talked about. If you've ever been to a mall in the past 2 years, you've seen, the empty storefronts. More and more people are buying online. We already knew that, but thanks to the pandemic, everyone quarantining, you had to buy everything online, whether it was your groceries or everything that you used to go to the store for. And more companies have offerings just like Amazon, whether it's, Target, all of these other e-commerce companies now. And so you have to have a lot of warehouse distribution, logistics centers. And what's fascinating is that there's a tremendous demand all over the country for a lot of these industrial properties. And so from a real estate investment perspective, you could look at office, you could look at hotel and see some of the pain and the challenging headwinds that have taken place there over the past 2 years. But there's a lot of, really positive and attractive opportunity in other parts of the market right now. And that's what gets us really excited.
Also, it sounds like, this is creating a lot of opportunities, which is really exciting to see all these changes. Ed, what are you seeing? What's Red Swan?
Yeah, well,
the past couple years.
Thank you very much, Kevin, for bringing me on. I agree with Ian and David. I think that we see a lot of activity based on really one factor we think is value add. That's been a consistent theme for the past not only 2 years, but 5 years. And that's where investors are actually looking for opportunities where they can, grow that yield on the asset. Buying an asset that actually has no rent growth and no upside opportunity has been challenging, but especially with cap rate compression, trying to find an asset that you can actually grow your revenue with and grow rents. That's been, I think, the theme that most investors have been looking at. And as what Ian said with regards to the mobility, I think that that's also helping for rent growth. And rent growth has been really the target for most investors, especially in the multifamily area. So you're looking at investors who are buying real estate in areas where they can actually grow the rents, in some cases 15, 20%. And that has a lot to do with that mobility factor that was talked about. They're looking for areas where they can, make some improvements, increase the look and appeal and the amenities of the apartment building or office building, and generate much higher rents, which will actually drive the type of returns they're looking for on an annual basis.
Okay, you talked about you're talking about the value add, and increasing the rents. I mean, what is the biggest factor in doing that? How are these investors, developers, getting more value out of these properties?
Well, they're scouring the markets and really looking at competitive markets, looking at competitive properties to see, if you're looking for the kind of the ugly duckling in a certain marketplace that has higher rents. So like a B value property that might be 80s or 90s construction in an area where you see a lot of new construction growing. There are, 2021, 2022 type product. And so when you're seeing rents at that, class A level, and now you can buy a B asset that may have 50% less value, that gives a lot of opportunity where you can improve the amenities of that asset and then bring your rents even maybe 50% of where the total market rents are for Class A. And that creates significant yield down the road. So that's really the objective, is to buy a project, buy low, make some value to it, increase rent, and then sell at a higher exit point.
Gotcha. Okay, thank you. Ian, I want to go back to you. And so inflation has obviously been a huge topic recently. How is that affecting multifamily and commercial real estate right now?
So we think about inflation and multifamily. I think there's two kind of distinct things that are going on. I'll start first on the development side and then talk also about the acquisition side. Talk a little bit about what Ed was referring to in terms of value add. So on the development side, what you've seen is just massive spikes in construction costs. I think, if we think about these themes over the last 2 years, every time that we talk to a developer, it's really about where are you in terms of solving to certainty of your construction cost. You can look at lumber as a good example, because we can look at the index of where this stuff is trading. Lumber pre-pandemic was $350 per 1,000 board feet. That spiked up over $1,600 per 1,000 board feet, after, during the pandemic period. We saw it come all the way back down to $380, I think, dollars per 1,000 board feet. And then now it's back up over 1,000, it kind of hit as high as 1,200 again. And so what that really tells you that we're on this kind of roller coaster of costs. You roll it all up, and construction costs have been up probably 12% kind of consistent year over year for the last couple of years. So that means that just the price of building something today is just a lot more than it was in the past. So developers are trying to navigate that, which is why you probably haven't seen quite as much of the multifamily product deliver as you might have thought you would a few years ago. Just because some deals have kind of been stopped or penciled, or they're kind of figuring out their costs. And as they do, they got to kind of go back and figure out their whole development project. So first, just massive spikes in construction costs. On the acquisition side, all that cost increase is also, as Ed was referring to, is translating into big increases in rents. One metric that we look at in terms of kind of these value add deals is when you have a market that has moved, as Ed was talking about, you find that kind of ugly duckling in the market that now looks really good. You have an older asset that could probably live a lot nicer if you could improve it. One metric that we've seen reemerge is what we call this. It's this 20% return on cost of the unit turn. And so real simple example. You buy an apartment complex. If you spend $10,000 in that unit, you replace some of the kitchen, the countertop, and the sink and the fixtures. You put new flooring in and carpet, paint it, light fixtures throughout it, right? You spend $10,000 making that apartment look nice, a lot nicer than it did before. Can you get, basically bottom line, about $170 to $175 more per month in rent for that? You can do that again today. And we used to see that kind of return as possible in 2015, 2016. It kind of started to trend down into more of the lower teens as the cycle aged. Now with this massive rent growth that we've seen, that 20% return on cost is now achievable. The other thing you can do is you can back into like, well, am I improving the value of the asset? And the answer is yes, and substantially. If you were to take kind of a current cap rate on a multifamily project, improve that, would spend $10,000, improve that unit, get that $175 worth of additional revenue, kind of all drops to the bottom line. So you get that net operating income pop. You probably just increase the value of that particular unit $40,000 to $50,000, kind of depending upon where it is and what it looks like. So that's the way to kind of earn your way to a return right now in the value add space. So, and it's really being done on the backs of all this rent growth that we've seen kind of transitioning to the inflation. So that's kind of what we see in the multifamily market on both sides.
Okay. That I think that kind of answers some of my next questions. I want to hear from each of you, and how real estate is a hedge against inflation. I mean, you see it touted as that, and so I'd like to hear from each of you on what it is that makes real estate a hedge. Ed, go ahead.
Sure, thank you. First of all, I just want to touch back on the last comment in terms of inflation, because that's very, very critical right now in real estate, because many people have been buying commercial real estate and paying very high prices, especially in the multifamily, because it's kind of the darling of the industry. But they were assuming that interest rates would continue to go down, and people have been very successful because interest rates have been compressing over the past 5-6 years, and therefore everyone looks like winners. But now that inflation is starting to hit and you're seeing interest rates climbing, it could be problematic for people who bought something at a 3 cap and did not lock in their interest rate on their debt, and debt being a very substantial part of the actual cost of capital. They could have problems if now that debt is floating up to 5-6%, and their cost of buying the asset is 3%, and that value add doesn't work. So that's a dangerous point. But in terms of a hedge, I think real estate is a commodity that's a limited asset, durable asset that's limited value. So you can always kind of raise your rents because demand is going to always kind of help keep the stability of the value in one place. So I think that those who are buying real estate with a positive leverage, meaning they're buying with an interest rate that is lower than the purchase price, I think they're going to definitely have a hedge against inflation, because as people are now moving into units and paying a higher amount of rents, you're actually keeping pace with the cost of capital. So those are the two inflation situations I think are key to pay attention to.
Thank you. David, I'd like to hear from you. What reasons you have that real estate is a good hedge against inflation?
Sure. Yeah. And just to, follow up again on the value add comments, what I think is interesting also is that in addition to doing those improvements on units and making a property, better through value add, work, there's other things also. You have the mark to market rent increases. If you're buying an older asset that maybe wasn't professionally or institutionally owned, the owner maybe didn't know what market rents were. So there's rental improvement that you can do there, but also the other side of the balance sheet, right, is reducing the cost of operating a building through institutionalizing, professionalizing those services, reducing the cost on one side, increasing the income on the other side can have a very powerful impact on ultimately the overall value of that asset. And when you think about inflation, we've touched on some of the aspects here already, right? So the rising cost, if lumber's going up, you would expect maybe less construction, right? So less new construction, limits supply. So the existing assets in that market, you would expect to go up in value if demand is staying the same or increasing, which is certainly what we're seeing in a lot of markets right now. High demand, limited new supply, it's going to push up valuations. And when you are seeing new construction, really high growth markets where maybe rent growth is really strong and is in line with the additional cost of the new construction, those new buildings that are being built, they need to command very high rents in many cases to cover the higher cost of the construction. And what that does is it also allows other properties, especially the buildings built in the past few years, to also increase their rents as well. So it increases by limiting supply, you're increasing the value of the existing inventory, but you can also see additional increases through new supply that's coming online, as long as you're in a market that's not really being overbuilt. But in the aggregate across real estate, different asset classes or sectors within real estate have different mechanisms that I think really can help hedge against inflation. With multifamily, certainly rising rents can help you a lot there. Hotels, if you have a hotel, you can actually change your rates on a daily basis in real time based on changing costs of managing that business. When you have offices or industrial properties where you have longer term contracts, you might be able to pass through rising costs onto those tenants in those properties as well, or have escalation clauses built in. So year over year, you actually have a 2 to 3% increase in the rent baked into the contracts over time that also help hedge against inflation. So I'd say there's a number of components that are very real across real estate that help either mitigate the cost impact, rising costs, or increase your income and the value of properties through inflationary periods. And just one other thing to touch on, as Ed was talking about the value of debt and how important that is in the capital stack for most real estate transactions. If you own real estate today and you own it with long-term fixed debt, that actually feels a little bit more like an asset if interest rates start to rise. If inflation is rising and those same dollars will buy you less in the future, you're paying back that debt over time with money that is worth less in the future as inflation is rising. So there's a whole number of, I think, very real, tangible ways where real estate operators and owners and investors don't have to do fancy, derivatives trades or hedging things. It's baked into just the DNA, if you will, of how real estate typically operates in this country that really can, help you protect against inflation and perform well. And just one final point, and I think Ian touched on this a bit, is there have been numerous studies, and we did a pretty deep dive into both rising interest rate environments as well as rising inflation environments here at Cadre using our data science team. And we found actually that real estate performs quite well in higher inflationary periods. It has historically performed well. And, I don't know that the future is going to be the same as the past, but it gives us some reason to be hopeful that you have the rational story of why it can perform well. And you've seen historically it has actually. And even in rising interest rate periods, we've seen that historically real estate has actually performed quite well in those rising or higher interest rate environments. So I think across the board, there's a lot to be hopeful for. If you don't have assets allocated to real estate today, it's not too late. If you're worried about rising interest rates or you're worried about rising inflation, I think it's a great time to be looking at the asset class.
All right, thank you. Unfortunately, I think we're out of time. I wish we could, sit here all day and talk. I got a whole long list of questions I'd love to ask you guys. But hopefully we have you guys back soon. Thank you so much. Again, we've got CrowdStreet, Cadre, and Red Swan. If anybody's interested in getting into real estate, definitely go check out these platforms. Some really exciting offerings they've got. Thank you, guys.
Thank you, Kevin. Appreciate it.
Thanks, Kevin. Thanks, everyone.
I want to add that the links to all those companies are in the description of this video, so check that out. Kevin, real fast, before I let you go, we're up against the clock. Question from the chat. Do any of those companies, to your knowledge, specialize in warehousing? Do you know?
I think all of them, have some warehousing from time to time. I know CrowdStreet has recently had some developments.
Okay.
I think you just got to watch the offerings and, you'll see some opportunities.
All right. Kevin Vandenboss is our real estate guru. Thanks a lot, Kevin. Great stuff.
All right. Thank you.
All right, I'm going to move it along to our last segment here of the day. We're going to do another Explain Like I'm 5 segment, mostly just because I wanted an excuse to play that fun graphic again. All right, Reg A, Reg D, Reg CF, alphabet soup. What does that even mean? If you have no idea, if you're as confused as I am, don't worry. Aaron Shafton is here. He's the head of marketing at Dealmaker. He can explain this stuff to us like we're 5. Aaron, what's up, man?
Spencer, how's it going?
I got all these letters in my head, and I don't know what any of them mean. So let's start with that. Reg A. Explain that.
Yeah, well, I think we can zoom way out. If
even better. The more zoomed out, the better.
If you're really 5 years old, we can go way out. If you pull someone off the street, if I step outside right now and pull someone off the street, and I ask them to explain buying a stock, 9 times out of 10, they're going to describe the process of like opening a brokerage app on their phone or a bank. They're going to go to a stock exchange. They're going to buy IBM or something like that. And that's, buying a public stock, right? It's listed on a stock exchange. There are, of course, other ways to invest money, right? Like there are companies not on the stock exchange who are raising money all the time. They have investors. And typically, like I'm not a lawyer, and if a lawyer's listening to this description, they're going to cringe a little bit. But if you're gonna offer securities privately and you're going to invest privately in securities, you need to do so under an exemption, right? Because not everyone can invest privately in something. Typically, if you're not a big institution, the only way you get access to private investments is if you're really high net worth. You're what's called an accredited investor. You make a certain amount of money, or you have a certain amount of assets. And it's a lot, like less than 10%, or depending on where you look, less than 5% of people in the US are accredited. So there's this giant pool of, investors. They want to invest in great companies before all the rich people have had the chance to. And, there are companies trying to raise money and they're missing 95% of the market. So Reg A is a pretty unique kind of mechanism. It's Reg A itself is pretty old, but in 2015, the Jobs Act kind of supercharged it. That's why people call it Reg A plus. And it lets companies raise money from the crowd. So it unlocks two things. It lets everyday people invest. You don't need to be accredited anymore to participate in this private transaction. And it also lets the company solicit or advertise. So you're increasing the accessibility of your offering with two levers. You can tell more people about it and more people can come in.
Got it. So, and that was like the first exemption, right? the Reg A exemption. You said that's been around for a while.
So the exemption that most people think of in like a traditional, it's called a private placement of securities, is Regulation D, particularly Reg D 506B, if we want to get into it a lot.
Whoa, too much, man.
Well, too many letters. I know.
Too many letters.
That's what lets, I've got a company, I'm trying to raise money. I go after a number of high net worth investors. That's kind of traditional. Reg A has been around for a while. Before the Jobs Act, I think you were capped at maybe 5 million in the amount of money that you can raise. So going through the hassle of filing all the paperwork wasn't really worthwhile. They bumped it up to 50 as of 2015, and then in 2021 it went even higher to 75 for a tier 2 offering. So now you can really get some juice going. Got
it. So, and then Reg CF, the different exemption, right? But same idea.
Yeah, it's like the smaller, it's the Reg A light of exemption. So a little bit easier to get going. There's a little bit less paperwork you've got to go through. Originally, you could only raise up to just over $1 million. They bumped that in 2021 as well to $5 million. So depending on the type of company you are, to the investor, it's a similar experience. There's some more bells and whistles in the Reg CF process, but depending on the type of company you are, how much money you need, you might go down either path.
And then when you and I were talking before, you made the comparison. Well, you made a couple comparisons. One of them was like the store versus the shopping mall. Can you just repeat what that comparison was? I'm sure I butchered it in some way, shape, or form. But and this gets at sort of where a company like yours, right, like Dealmaker sort of fits in, right?
Yeah, I mean, Spencer, I think you're hard on yourself. I don't think you butchered it at all.
Nice.
Reg A, Reg CF is new, but it's not brand new anymore, right? People have been raising money like this for a couple of years now. And predominantly the approach to raising that money has been to put, your offering, your deal on a marketplace, right? And we've heard some of the marketplaces mentioned today, and it's an approach that works for a lot of companies. But as the space has grown, what we've seen is more and more sophisticated issuers start raising money from the crowd. So, 2015, 2017, going to an audience of strangers on the internet was maybe something you did if you couldn't get the VC money or you couldn't get the private equity fund. Now it's something that even major brands are deciding to do instead of going the traditional route. And when they do that, Chanel doesn't sell on Amazon, right? There's a place in e-commerce for a marketplace where you're shared with other brands, but there's also a place for, a Shopify store or a Main Street retail location where you own the process. And that's what our technology does. We let, the sophisticated issuers who want to go raise serious money and have a serious brand already, raise money directly from that brand. They don't need a new community. They need to convert their existing community, and they need tech to do that.
If I was a company, a Spencer Co., right, why would I want to go through this process? Any of them, the Reg A, Reg D, Reg CF. Like, aside from raise money, I could raise money lots of ways.
Yeah, I think that's a great question. Depending on the fundamentals of Spencer Co. and your outlook on the world.
It's shaky at best, but
I've never done the roadshow thing. I've never gone and raised VC money, but I listen to a lot of founders who do. And when you raise capital like in equity financing, you are very literally giving up control of your business. You know what I mean? And I think when you talk to some founders, flying up and down for months, taking up all their time, playing Pokemon Go for term sheets, you lose control over that process.
Wait, what was that last part?
You're chasing after term sheets everywhere, and you're running around, and you lose control over the process. And I think if you have the asset on hand of an active community or a really great brand that you're already advertising outwards, or a product or a service that really resonates with people, and you think you can mobilize what you're already doing in the market to raise money, why wouldn't you turn that into capital? Now, when you spend a marketing dollar, it's working twice as hard. It's marketing your business. It's also acquiring investors for you. That's really attractive to a lot of issuers. And you get, a lot of more transactional benefits. You own the term sheet. Now you're dictating the terms. You get 12 months to raise your capital. It's a more involved and kind of community-focused way to raise money.
Awesome. Aaron Chaston, Dealmaker, explaining to us, the basics, the fundies, the fundamentals of Reg A, Reg CF, Reg D. Aaron, we'll get you back on again. Thanks for coming on our very first Listmaker show. This is but a step into an entire universe of companies and investment opportunities. And as I said earlier on the show, I'm bullish for a lot of reasons. One of them being the fact that there's more to life than just stocks, and companies like yours are making life easier for individual small investors like me. So thank you, Aaron, and thanks for explaining this to us like we are 5.
Thanks, Spencer.
All right. Hey, here's what I got to do. I got to wrap up. Before I do, I have to thank our sponsors for today's show, one of which is Cadre. Okay. We had David Vincent just now on our panel. Let me just play this quick video for you from Cadre. Check it out, Cadre. Again, link is in the description. All right, we got to go, and here's why we got to go. Benzinga Live should have gone live already. Big guest on the show today, right now. If you're a racing fan, you're going to like this one. We're talking to Bill Sandbrook. You won't know who that is if you're a racing fan, but you will know the name Andretti, yeah? As in like Mario, as in Michael Andretti. Right, his son Michael Andretti will be I think on Benzinga Live right now. We got to end this show and redirect to that show. What kind of company are they looking to buy? We'll find out. Any racing questions about anything about racing? Drop it in the chat for Michael Andretti on Benzinga Live right now. So without further ado, I'm going to end this show. We are looking for feedback. As I said off the top, this is our very first Listmaker show. We're going to do one of these a month on a different theme. Let me just tease the future shows, okay? I'm not going to give anything away, but we're doing a show on NFTs. We're doing a show on ETFs. We're doing a show on cannabis. We're doing a show on SPACs. We're doing a show on EVs. We're doing a show on NIL, name, image, and likeness, ways to get exposure to that if you're a college sports fan. So a lot to come. The next one of these shows will be the end of February, so stay tuned for that. Thanks to all of our sponsors today. Let's thank them all for supporting Benzinga, Red Swan, WeFunder, Cadre, CrowdStreet, and Dealmaker. Without them, we could not have done this show. All right, I got to go. Michael Andretti is on Benzinga Live. That means I got to end this stream so we can redirect you to that. Everyone have a great rest of your day, and go watch Benzinga live.